Good evening, Forex trader. Let's consider a profound truth. An individual's personality profoundly shapes their trading journey, influencing every decision, from the strategies they embrace to the risks they undertake. Understanding one's psychological makeup, that is, those unique traits that define how one thinks, feels, and acts, can unlock the potential for greater success in Forex trading. By aligning trading practices with one's personality, a trader can harness their strengths, temper their weaknesses, and craft a path to consistency and profitability. Allow me to elucidate how personality impacts trading and share detailed strategies to leverage it effectively, fostering a deeper connection between your inner self and the markets you navigate. Personality, often categorized through frameworks like the Big Five, encompassing openness, conscientiousness, extroversion, agreeableness, and neuroticism, serves as the invisible hand guiding a trader's actions. Consider risk tolerance, a cornerstone of Forex trading. Traders high in openness, with their penchant for novelty and exploration, may gravitate toward exotic currency pairs or innovative strategies, such as algorithmic trading with emerging market currencies. Yet, without discipline, their curiosity can lead to overdiversification or chasing untested trends. Conversely, traders with low neuroticism, marked by emotional stability, remain steadfast during the volatility of a US dollar to Japanese yen swing, adhering to their plans while others falter. Those with high neuroticism, however, may find their resolve tested, selling prematurely during a sharp pip drop or overtrading in a frenzy to recoup losses. Recognizing these tendencies allows traders to tailor their approach, ensuring decisions align with their psychological wiring rather than market whims. Discipline, a trader's bedrock, is deeply tied to conscientiousness. Highly conscientious traders, with their meticulous nature, excel in the structured world of Forex. They meticulously analyze economic indicators, maintain detailed trading journals, and adhere to risk management protocols, such as limiting exposure to 1% per trade. Their plans are as precise as a Fibonacci retracement, and they thrive in strategies like swing trading, where patience yields rewards. Less conscientious traders, however, may struggle with such rigor. They might skip fundamental analysis of a pound sterling to euro trade or neglect stop-loss orders, swayed by intuition over evidence. For these traders, simplifying strategies, perhaps focusing on a single currency pair like Euro/USD or employing automated tools, can bridge the gap between aspiration and execution, fostering consistency where instinct alone falters. The social dynamics of trading, influenced by extroversion, further illustrate personality's role. Extroverted traders, energized by interaction, find value in Forex communities, whether discussing non-farm payroll impacts on X or joining webinars with market analysts. Their networks provide insights into sentiment shifts, such as a sudden AUD rally. Yet, their enthusiasm can lead to pitfalls, like following social media hype into overbought pairs without due diligence. Introverted traders, by contrast, prefer solitary analysis, diving deep into technical indicators like RSI or Bollinger Bands. While their independence shields them from market noise, they risk missing broader perspectives that social engagement offers. Both can thrive by balancing their natural inclinations, extroverts grounding their trades in data, introverts occasionally seeking external input to challenge their assumptions. Emotional biases, shaped by agreeableness, also play a pivotal role. Highly agreeable traders, with their trusting disposition, may rely heavily on mentors or brokers, potentially overlooking red flags in advice about a Canadian dollar to Swiss franc position. Their reluctance to take contrarian stances might cause them to hold losing trades, hoping for a reversal. Less agreeable traders, skeptical by nature, may excel in contrarian strategies, shorting an overbought euro to pound sterling when others buy in. However, their stubbornness can lead to clinging to flawed positions. By cultivating self-awareness, agreeable traders can learn to question advice critically, while their less agreeable counterparts can practice humility, admitting errors to exit losing trades swiftly. Overconfidence and impulsivity, often seen in highly extroverted or less conscientious traders, pose additional challenges. Overconfident traders might overestimate their ability to predict an ECB rate hike's impact, over-leveraging in a high-stakes trade. Impulsive traders, driven by excitement, may enter a US dollar to Canadian dollar position without analyzing resistance levels, chasing quick pips. These tendencies, unchecked, can erode capital faster than a margin call. Mitigating such risks requires deliberate strategies, such as enforcing a 24-hour cooling-off period before trades or capping leverage at 10-to-1. Ensuring decisions reflect reason rather than emotion. To leverage personality effectively, traders must first embark on a journey of self-discovery. Taking a personality assessment, such as the Big Five or Myers-Briggs, offers a mirror to one's tendencies. Reflecting on past trades, perhaps a panicked exit during a CHF spike or a disciplined hold through an NZD dip reveals how personality drives outcomes. A trader high in neuroticism, for instance, might recognize their emotional volatility and adopt automated stop losses to enforce discipline. This self-knowledge forms the foundation for a trading approach that feels intuitive, reducing the friction between one's psyche and the market's demands. Next, traders should align their strategies with their personality strengths. Conscientious traders, with their love for order, might develop a systematic approach, backtesting a strategy on euro to Japanese yen across historical data to ensure robustness. Open traders can explore cross-currency pairs like pound sterling to Australian dollar, but should set clear parameters to avoid overtrading. Extroverts can leverage platforms like X to gauge market sentiment, cross-referencing posts with economic calendars to validate trends. Emotionally stable traders, unperturbed by a sudden JPY surge, might pursue carry trades, capitalizing on interest rate differentials. By choosing strategies that resonate with their natural tendencies, traders create a harmonious relationship with the market, enhancing both confidence and performance. Addressing weaknesses is equally critical. For emotionally volatile traders, mindfulness practices, such as deep breathing before placing a trade, can temper reactions to a USD/ZAR plunge. Less conscientious traders might adopt a minimalist strategy, focusing on one or two pairs to reduce complexity, or use platforms like MetaTrader to automate entries and exits. Overconfident traders can limit position sizes, ensuring no single trade exceeds 2% of their account, while agreeable traders should practice skepticism. Backtesting a mentor's Australian dollar to US dollar recommendation before acting. These adjustments transform potential liabilities into manageable quirks, paving the way for disciplined trading. A personalized trading plan, rooted in personality, serves as a trader's compass. Risk-averse traders, low in openness, might focus on stable pairs like US dollar to Swiss franc, minimizing exposure to volatility. Time-constrained introverts can opt for position trading, analyzing weekly charts to avoid the frenetic pace of scalping. Emotional traders should steer clear of high-frequency day trading, which amplifies stress, instead favoring longer-term trends. This plan should include specific rules entry criteria, risk-reward ratios, and exit strategies tailored to one's psychological comfort zone. Ensuring trades feel as natural as a well-timed pip gain. Technology offers a powerful ally in this endeavor. Analytical tools, such as TradingView's charting features, empower introverted traders to refine their technical analysis, plotting support levels with precision. Extroverts can follow influential X accounts for real-time Forex insights, filtering noise with fundamental data. Automated platforms, like CTrader, allow impulsive traders to execute preset strategies, bypassing emotional triggers. By integrating these tools, Traders amplify their personality's strengths while safeguarding against its blind spots, creating a seamless bridge between mind and market. Finally, the pursuit of mastery demands continuous growth. Traders should maintain a detailed journal, logging not only trades but also emotions and thought processes. Did fear drive a premature pound sterling to Canadian dollar exit, or did confidence justify a hold? Regular reviews uncover personality-driven patterns, guiding refinements. Extroverted traders can seek mentors or join Forex forums, while all traders benefit from education, deepening their grasp of macroeconomic drivers like interest rates or GDP releases. Psychological training, such as cognitive behavioral techniques, can further hone emotional resilience, transforming biases into opportunities for growth. Finally, traders, your personality is not a barrier but a beacon, illuminating the path to Forex success. By embracing your unique traits, whether the discipline of conscientiousness, the curiosity of openness, or the stability of low neuroticism, you can craft a trading approach that feels authentic and effective. Mitigate your weaknesses with tools, strategies, and self-awareness, and let your trading plan reflect the best of who you are. As you stand before the charts, know that the market is not just numbers, it's a canvas for your personality to shine. See you in our next presentation. Thank you.